It should come as no surprise that the RBA met this week and actually increased the interest rates again. Now, we've been expecting this, we've been talking about this on the channel, and in this video, we're gonna break down what this actually means for, homeowners like yourself, if you're looking at potentially buying something, and if you're someone that's renting, because that's about to get a whole lot worse. If you are interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, earlier this week on Tuesday, we had the RBA meet again, and they had done what basically most people predicted. I was expecting about a 0.5% increase, so 50 basis points. That would take us from 0.85 all the way up to 1.35, and that's exactly what happened. Now, I know I say this with a smile on my face, but I understand that there are people now starting to feel the pinch. We've gone from 0.1% all the way up to 1.35%. Something that most people thought would never happen. Some people thought it was going to happen. And for someone like me, I think it's short-term pain for long-term gain. And what I mean by that is when things get volatile, when things get changed from an easy mode into a more difficult mode, we start seeing the bad operators as well as the silly investors get out of the market. Now, I'm an investor myself. So what do I mean by silly investors? What I mean is that people thought over the last couple of years, as property prices increased, I could literally buy anything and it would go up. This then caused bad vendors doing bad practices as well as selling agents. Now, what I'm alluding to here is that people started actually selling their homes that they knew had issues in their homes, and they were selling it to people that were buying straight cash deals just to get in, not have any loans, as well as that they went in with no pest and building inspections either. So can you see there being a potential issue here? Yeah, I do. And that's what we were competing with over the last 2 years. Now, suddenly that we've seen the interest rates go up so quickly, people have now started pulling back and the demand has fallen. But let's not get this confused. You can see the headlines that we're dropping faster than any time ever before. It's the biggest decline in housing growth in like 50 years. Well, no shit. Of course that's going to be the case when you've grown the fastest that you've grown in over 30 years. It's just common sense. We all expected that the prices will start slowing down when it comes to housing growth. I've said on this channel for like the last 12 months that we will return to a rate of normality. Now, the new norm is going to be different to what we saw before. But let's dive into what happened with the RBA earlier this week. So the governor of the Reserve Bank of Australia, Philip Lowe, signaled more rate rises are likely in the coming months. The size and timing of future interest rate increases will be guided by incoming data and the board's assessment of the outlook for inflation and the labour market, he said in a statement. The board is committed to doing what is necessary to ensure that inflation in Australia returns to target over time. Market analysts suggest the cash rate could end up somewhere between 2 and 3%. So the target range that they ultimately want is 2 to 3% inflation. Now, at the moment, if you believe what's coming out, is probably somewhere between 5 and 7%. And that's what we are trying to reduce. And how you do that is obviously the flow of money. You reduce the flow of money by increasing the cost on debt. They can have credit cards, they can have car loans, things like that. And when a big portion of your budget goes towards that, it means less can go into the economy in terms of cafes, restaurants, and things like that, which contracts the economy. And that's effectively what's already happening. Now, what is different this time compared to previous increases is that the media moves very quickly. You've also got YouTube channels like myself informing people like yourself, but then there's a bunch of people on TikTok talking about this stuff as well. So the information spreads a lot quicker, but with that comes analysis paralysis for a lot of people. They start doing their numbers, and that ultimately means people aren't active in the market anymore. They think the worst possible thing that could happen. They don't zoom out, they don't have a strategy, and then you go out thinking, oh my God, like I'm reading these headlines, I'm watching Channel 9, the world's gone to shit. And that means that we actually have a greater effect of small movements. So the volatility, I think, is not going to be something that just stops now. I think it's going to be a big part of our future, and it's something we need to consider when we look at long bear markets, long bull markets. I think we're going to start getting more shifts very quickly. Now, as a result of the interest rates going up due to inflation, you then have other things that flow on from there, which is that equity markets get smashed. You start having slower house growth, especially in areas like Sydney and Melbourne where it's already unaffordable, and then your cash flow is absolute crap. So you're going to start seeing those markets move fairly quickly in the opposite direction. Now, I said this about 7 months ago. I said, hey, look, Sydney and Melbourne are probably going to be the ones that feel the pinch the first. They're not going to be the last, but they're probably going to be the first. And yet some people still decided to go buy there. Now, if you're sitting on a property worth 1.1, 1.2 million, you're probably going to see a haircut of about 10 to 15% over the next sort of 12 months. Your share market portfolio is going down, your crypto is going down, your housing price going down. Suddenly it starts feeling pretty depressed. And what I bring to your attention is here the Australian consumer confidence levels. And you can see basically from 2021, we are in free fall, and we are now at levels only seen previous to this in the last 25 years. at the time of the GFC and during the COVID crash. And based on how quickly we're moving and inflation being so high, as well as people paying a shitload at the petrol stations, I think we're going to start seeing levels very close to the GFC, and then we're probably going to get to the COVID levels. Now, does it feel like that? Ask yourself, are you scared? Are you looking at this market going, oh my God, like what the hell is about to happen? Now, for context, 2 years ago, we get hit with a virus that nobody's ever heard of, and it basically shuts down the world economy. Is this feeling similar to that? I don't know. I don't think so. And at least for the people I speak to on strategy sessions and discovery calls, it doesn't feel like it's peak fear, but at the same time, those that are active, the smart money are going out and building positions, which I definitely didn't see as much of back in 2020. This time around, the smart people that did make money and know how to make money, have strategies, are going out there and buying up as much as they can. On the flip side, there are people that are really struggling with just a household budget. You know, having your petrol go up, having energy costs go up as well. These things are really affecting the weekly budget, which means less can go and get invested. Now, with anything, when you're looking at data, when you're looking at graphs, as well as assessing your own mindset, you probably got to zoom out, get the emotions aside, separate that from the logic, and then figure out what's actually happening and how does this affect the entire economy, not just the housing market, but the entire economy. Now, this graph is the last 25 years of the cash rate. Now, there's a couple of things. We've obviously started seeing this increase, which has been the recent increases over the last 3 months. Let's take a more contextual view here. Now, what I think is happening over here in 2022 is very similar to what the move was in 2004 all the way up to 2007 and 2008. Now, I don't think it's going to go on for as long as it did. I don't think it's going to be a 3 or 4 year move. I think the whole entire economy collapses before that. But what I'm trying to bring to your attention is that we had seen a higher high from the previous high in 2000 and 2001, but it wasn't sustained. And this is what I'm trying to point to, is the problem here is not inflation. It's not the fact that house prices are going down in some areas. It's the fact that the quicker we move after having taken on so much debt, the problem will be the solution. And the solution here is not looking like interest rates going up is going to fix all the problems. I think it's going to be the counter. I think when you have interest rates going up, you've got petrol and energy prices going up as well, you're going to find yourself in a position where you get companies collapsing, you get people that can't find jobs anymore, and we're still early in this process. So I think it's going to take some time to play out. But when this starts playing out, the government will be aware of this, and that is when they're going to have to pivot, and that is pretty much what everyone is waiting for in the US as well as the world economies. For some context, with the US, they've gone and increased their rates a lot faster than we have, but they are about to print a recession. An official recession will be printed on July 28th, and that is when it's going to start making some more headlines and causing further fear, which is probably going to stop people from, actually spending more. They're going to start saving more of their cash. But when I look at this chart and I say, well, okay, we've gone from emergency levels of 0.1%, which nobody ever thought we would get to. Now we've started increasing. Where are we in the bigger picture? Now, we haven't even reached the levels of 2019, which is only 3 years ago. And in 2020, we had to go in emergency mode because the lockdowns occurred. So if we look back in 2019, that was a fairly normal market. And that's where we are headed right now. We're headed into a return to normal, except this time we have so much more debt and the systems are broken. So contrary to what some analysts are suggesting that we could see a 3% cash rate, which would be an extra 1.65% from here, I think it's going to slow down a lot quicker than that. In my opinion, I think we see maybe 2, possibly 3 more rate hikes later this year, and it's probably going to be the end before we start consolidating. We start testing how the economy is coping with it, how everyone's coping with it, and before we realize the government says, yeah, inflation suddenly is all good and the economy is about to go to shit, we better pivot. And what that pivoting looks like will be that maybe we start cutting rates again. Now, I don't know how quickly this happens, but I think over the next 12 to 18 months is going to be a unique opportunity where there's uncertainty. I've mentioned this in a video before. Definitely go check out this one where I'm sharing why I thought there was uncertainty in 2020 and I decided to go and buy. Why I'm finding the uncertainty now is a perfect time to go and buy again. Now, this chart here takes us to about 2021, but the main point I want to make here is that even if we see these increases in rates, and we're saying worst case, I'm saying maybe we see another 1.5% increase, that's only going to take our home loan rates back to these levels in 2019. Now, if you're sitting there and thinking, well, okay, prices are going to come down and they're going to start collapsing all of a sudden because rates have gone back to 2019, are you telling me that prices didn't grow before 2019? Now, we had APRA come in and they intervened around 2017 and 18, which slowed down the price growth, especially in capital cities. But regional markets had no problems going up. So if you look back, and I've basically been investing, I bought my first property all the way in 2011, 2012, and having seen my portfolio portfolio grow even in times where home loan rates were going up. I fixed rates because I got scared as well. A lot of people are doing the same thing. And what I'm seeing is the same pattern recognition that I saw back then, I see again here. So where to from here? Now, I think the max pain is always going to be felt with the owner occupiers. This is why I continue to rent fest. I think that if you're going to buy a home, you should probably buy it debt free, and you're probably sitting there wondering,
how the hell do I get a house debt free for $1 million or more?
And that's where you need to have the right strategy. If you need a hand in getting the right people around you, definitely look at the link in the description below to my website, Search Property AU. That's where you can find some information around booking a discovery call as well as strategy sessions. And it's very important to get the right mentality right now. Now, just because you made money over the last couple of years doesn't mean you're going to make it during a time where things are a bit uncertain. That is when the biggest mistakes get made. I urge you to stay calm. I had some comments before where they say, oh, well, prices are going down for everything, when it comes to stocks, crypto, and things like that, yet you're still so calm and happy. How do you do that? It's because I have a conviction around my play, around my strategy, and I'm an active investor. I do this day in, day out. I love this stuff, and that's why I try and share as much information with you guys as well. So I urge you guys, take this information on. If you need to share this with someone, maybe it's your partner, maybe it's a sibling, definitely smash that share button and hit the like button so the YouTube algorithm can push it out to the people that really need it. I hope you guys have enjoyed this video, and I'll catch you guys in the next one. Thanks, guys.